You've seen the headlines. I made $21,000 last week through options trading. Sounds easy, right? But what they don't tell you is the absolute reality of this trade for an average person. I'm May. I traded 13 years of corporate for financial freedom, and I'm teaching you how to do the same. Stay with me as we do the math. I'm going to guess that this person is trading covered calls. If you don't know what that is, let me break it down for you. Pretend like you're going to a restaurant. You see a price for the prefix menu today. It costs $100. You think that the restaurant might actually raise its prices by the end of next week, and you think it might be closer to like $120. In this case, what you might do is pay a fee to the restaurant, reservation fee, for example, and say, hey, I want to dine at the restaurant next week, but I only want to pay the current prefix menu price, which is $100. So I'm going to pay you, let's say $2 reservation fee for the end of the week to be able to pay only $100 for the meal. What happens at the end of the week? Well, if the restaurant does raise its prices to $120, the good news is you get to dine for just $100. If the restaurant keeps its prefix menu price, you just lost the reservation fee you ended up giving. If the price goes down, you might end up saying, you know what, I'm actually not going to go to my reservation. I'm just going to let that $2 reservation fee go and dine somewhere else, because if I go, I'd have to pay $100 and now they're only charging $90. A covered call is very similar to that sense, except when you're selling it, you are actually the restaurant. You are taking fees from potential diners because they want to dine here, or in this case, stock. They want stock at a certain price. So the benefit of a covered call is you get to loan out the opportunity for somebody to buy your shares at a certain price. And if it doesn't hit that price by the expiration date, you get to keep the premium. It's a great way to earn money on top of the equity that you'll gain by the stock price also increasing. Now, if they were trading uncovered calls, that is actually tremendously more risky because you have to front the dollars to actually buy the stock if it hits the strike price. So we're going to assume that this person is not doing that. They're dealing with the covered call strategy. So how would someone like you and I earn $21,000 in a week through options trading? Get ready. The answer is going to shock you. Let's take an ETF like QQQ. The premium for selling a call option for the end of this week is around $1.67 a share. Generally, when you're selling, you're looking at the ask price. Now, the note here is that you have to sell at least 100 shares. So if you don't own 100 shares of a stock, this isn't going to work for you. In order to get $21,000 in options premiums, we'll need to take $21,000 divided by 167. That would mean you need 12,574 shares of QQQ in order to make that options premium. That roughly means you have to sell 125 contracts. Do you want to take a guess how much 12,574 shares of QQQ costs? If you're looking at the current price of the stock today, that's roughly $600. That is $7.5 million. I don't know about you, but I don't just have that type of cash lying around to invest it in one ETF. Now, it's possible that this person has owned these amount of shares over a long period of time. Let's say they actually purchased it at just the right moment. Let's say they bought it during the 2008 financial crisis when it was roughly $30. Even at that price point, they would have needed $300,000 back in 2008 to accumulate that many shares. If you're just starting out in options trading, that type of number is not feasible. Truthfully, even earning $2,000 a week is really tough without a robust portfolio. So I know you're probably wondering, why did you select that price? There's a lot of different other price points on this list that actually offer a higher premium. Well, here's the thing. I'm not going to go into the statistics and the probability in this video. What you need to know is that when you're selling a covered call, the closer the strike price is to the current price of the stock, the higher likelihood of the call getting exercised. So yes, you get a higher premium, but you're risking your stock potentially being sold at that strike price. And the benefit of options trading is that you get to maintain a position while collecting the premiums. The next time you see insane numbers being promised, think about all the information they're not telling you and stop chasing the hype. Follow Money with May for more realistic investing tips that won't break your savings.